Most people think of the dollar as something that lives inside the borders of the United States, under the watchful eye of the Federal Reserve. In reality, there is a second dollar system that grew up outside those borders, in European and offshore banks, that is now several times larger than the American economy itself. This world is called the Eurodollar market, and its dollars are not printed by the Bureau of Engraving and Printing, nor do they sit as reserves at the Federal Reserve. They are ledger entries in foreign banks and their offshore branches, promises to deliver dollars that are created and destroyed by keystroke. No single country issues them. No central bank fully guarantees them, yet they fund global trade, corporate borrowing, and speculative bets on a scale that quietly rivals anything happening in New York or Washington. The story of Eurodollars begins in the anxious years after World War II, when the dollar had become the anchor of the international monetary system. American power and production dominated the globe, and foreign governments, corporations, and banks wanted to hold their reserves in dollars rather than in weaker currencies. At first, those dollars mostly sat in accounts at banks inside the United States. But as the Cold War intensified and regulations multiplied, clever bankers and nervous politicians discovered reasons to move those dollars abroad. Soviet-linked entities, for example, preferred to hold dollar deposits in European banks, where they would be beyond the legal reach of American authorities who might freeze or seize them in a geopolitical crisis. European banks were happy to oblige, and so the first offshore dollar accounts were born. The key point was that nothing physical crossed a border. There were no pallets of green paper shipped across the Atlantic. Instead, a European bank would accept a deposit denominated in dollars and then claim a corresponding dollar balance at a correspondent bank in New York. Over time, as confidence grew, that link became more elastic. Banks outside the United States realized they could promise dollar deposits to customers, even if they did not have matching reserves sitting at American banks, just as domestic banks create dollar deposits by extending loans. The offshore dollar balance sheet began to expand. The term Eurodollar eventually came to mean any dollar-denominated deposit or liability held outside the jurisdiction of the United States, whether in London, Singapore, the Cayman Islands, or anywhere else. Several forces helped this offshore system explode in size. Regulations in the United States capped the interest rates that domestic banks could pay on deposits, making it hard for them to compete for global funds. Foreign banks faced fewer restrictions. They could offer more attractive returns on dollar deposits, lending those dollars onward to corporations and governments that wanted to borrow in the world's premier currency without dealing directly with U.S. rules. Capital controls and domestic banking regulations in many countries further encouraged firms to route their financing offshore, where the web of local laws was looser. What began as a small niche gradually became a parallel universe where dollars could be created, traded, and destroyed in ways that did not show up on the Federal Reserve's balance sheet. By the late 20th century, the Eurodollar market had become the funding backbone of global finance. Multinational corporations borrowed in Eurodollars to finance operations and acquisitions. Commodity traders used Eurodollar credit lines to move oil, metals, and grain around the world. Banks hedged interest rate risk and speculative positions with derivatives priced off Eurodollar futures and offshore dollar funding rates. The network was dense and intricate, with major hubs in London, Zurich, Hong Kong, and various island jurisdictions that specialized in offering light touch oversight. Every link in that network depended on trust. Trust that promises to pay dollars in the future would be honored when they came due, even though the promises themselves were created far from the reach of the Fed's traditional safety nets. What made this system both powerful and fragile was that it rested on balance sheets, not vaults. A Eurodollar deposit in a London bank is a claim on that bank, which in turn might have claims on other banks, which themselves might be relying on short-term funding to finance long-term assets. The dollar label suggests solidity and connection to the United States, but the actual chain of promises can weave through many jurisdictions long before it terminates in a genuine reserve asset. In good times, this does not matter. Payments clear, loans roll over. Everyone is content to treat Eurodollar deposits as if they were indistinguishable from domestic dollar deposits. In bad times, the differences suddenly matter a great deal. The scale of the Eurodollar system is difficult to measure precisely because it lives in the gaps between national statistical categories. Estimates suggest that offshore dollar liabilities, deposits, loans, and other instruments amount to several times the annual output of the United States. That means there are more dollar claims circulating outside America's legal borders than many people realize even exist. These dollars are not backed by a simple pile of reserves. They are backed by the collective solvency of foreign banks, their borrowers, and the collateral pledged up and down the chain. When confidence is high, this vast pool of offshore dollars lubricates global commerce and investment. When confidence wavers, that same scale becomes a problem because the backstop is fragmented and uncertain. The limitations of the Federal Reserve's control become clear as soon as one asks a simple question. What happens if a bank in London or Tokyo cannot roll over its dollar funding? The Fed's traditional tools, setting interest rates for domestic banks, adjusting reserve levels in the U.S. system, do not directly reach that institution. The Fed cannot simply order a foreign bank to change its lending, nor can it guarantee all Eurodollar deposits by decree. In times of acute stress, the Fed can and does extend emergency support indirectly, for example, by opening swap lines with other central banks, which then lend dollars onward to institutions in their jurisdictions. But this is a patchwork response layered on top of a market that normally runs on private judgment and improvisation. The global financial crisis revealed how much the world had come to rely on offshore dollars. When U.S. mortgage securities began to crumble, many of the institutions under pressure were not American retail banks, but foreign banks that had funded dollar assets using short-term euro-dollar borrowing. As panic spread, lenders in the offshore market pulled back, hoarding liquidity and refusing to roll over loans. The demand for dollars surged not just in New York, but in European and Asian financial centers. Only massive coordinated intervention, including unprecedented dollar swap lines and emergency facilities, prevented a full-scale funding collapse. Even then, the mechanics underscored the awkward reality. To stabilize a market it did not formally regulate, the Fed had to act as lender of last resort to the world. After the crisis, regulators tightened rules on banks' liquidity and capital in an attempt to make both domestic and offshore dollar funding more robust. Yet many structural features of the Eurodollar system remained. Non-bank financial institutions, such as money market funds and shadow banks, continued to provide and rely on offshore dollar funding without being subject to the full weight of bank regulation. Derivatives markets built on dollar benchmarks remain deeply intertwined with Eurodollar rates and availability. Corporations and sovereigns continued to issue dollar-denominated debt that depended directly or indirectly on the smooth functioning of offshore funding markets. The incentives that had created the Eurodollar world, flexibility, yield, and regulatory arbitrage, did not disappear. The result today is a two-layer dollar order. On the surface is the domestic system most people recognize: Federal Reserve notes, insured bank deposits, regulated institutions, and policy decisions that are debated in public hearings. Beneath and beyond that is the offshore system, a vast lattice of Eurodollar claims linking banks, funds, and corporations across continents. The Fed can influence this parallel system, and in crises, it can rush in as a firefighter, but it does not design its wiring nor fully supervise its construction. That asymmetry means the central bank must constantly watch shadows cast by markets it does not fully control, knowing that stress in those shadows can spill back onto American shores with surprising speed. The dollars that dominate the world, in other words, include many that do not truly live in any one country at all, and the institution tasked with guarding their value can only ever partially govern the places where they roam. From the very beginning, the Eurodollar market lived in a legal gray zone, and that ambiguity became one of its greatest advantages. No single legislature wrote its rulebook, and no single regulator oversaw its growth. European and offshore jurisdictions competed to attract business with favorable tax treatment, light touch supervision, and flexible corporate structures. A dollar booked in London or Luxembourg did not face the same reporting requirements or prudential constraints as a dollar sitting in a small American town's checking account. That difference was not a small technicality, it was the core selling point. Corporations could borrow and lend outside the reach of domestic capital controls. Banks could structure deals that would have been cumbersome or outright prohibited onshore. The result was a parallel universe in which dollars enjoyed freedom of movement that few other financial instruments could match. Freedom, however, always comes with a price. In the domestic United States system, a hierarchy of protection shields depositors and stabilizes banks. Deposit insurance for small savers, a central bank ready to lend against good collateral, and a political system that, in extremis, can authorize bailouts. Eurodollar deposits, by contrast, sit outside that safety net. The promise is only as good as the institution making it and the web of counterparties behind it. A multinational corporation holding hundreds of millions in Eurodollar deposits at a foreign bank knows that in a crisis, there is no guarantee a foreign government will step in with the same vigor or resources that Washington has historically deployed. That uncertainty is mostly ignored in good times, when competition and yield chasing dominate decisions. It becomes painfully salient when stress arrives. One of the most revealing aspects of the Eurodollar system is how it turns the Federal Reserve into an involuntary global actor. The Fed's legal mandate is domestic: maximum employment and stable prices within the United States. Yet every major rate decision, every shift in dollar liquidity, radiates outward into offshore markets that have grown dependent on cheap, plentiful dollars. When the Fed tightens policy, it does not just increase borrowing costs for American households and firms, it also tightens the noose on foreign borrowers who funded themselves in Eurodollars, often on the assumption that low rates would last. Emerging markets that issued dollar bonds, European banks that built portfolios of dollar assets, and hedge funds that used dollar leverage all feel the impact, even though they never appear on a Federal Reserve briefing memo as formal targets of policy. This dynamic cuts both ways. In theory, the Fed could ignore offshore distress and focus solely on domestic indicators. In practice, severe stress in Eurodollar markets quickly boomerangs back into the United States. If foreign banks cannot roll over their dollar funding, they sell dollar assets, pushing up yields and tightening financial conditions in ways that feed directly into the American economy. If a squeeze in offshore markets triggers a fire sale of treasuries, the very benchmark securities the Fed relies on to transmit policy can become volatile and illiquid. Under those conditions, the central bank faces an unwelcome choice: let the offshore dollar system burn and accept collateral damage at home, or intervene once again to stabilize a market it does not formally control. Repeatedly, it has chosen the latter, not out of charity, but out of self-preservation. This mutual dependence has political as well as economic implications. When the Fed opens emergency dollar lines to foreign central banks or stands ready to backstop global funding markets, it is effectively exporting its balance sheet. Critics at home question why an institution chartered to serve American interests should act as lender of last resort to foreign banks and governments. Politicians in other countries, meanwhile, resent the fact that their domestic conditions can be whipsawed by decisions taken in Washington based on U.S. employment data and inflation readings that have little to do with their own economies. The Eurodollar system thus creates a kind of informal dollar empire without clear constitutional boundaries, power without explicit treaty, obligation without formal accountability. Technologically, the Eurodollar world has also evolved. What began as simple deposits and loans in the second half of the 20th century has morphed into a dense web of derivatives, securitized products, and structured notes, all ultimately tied back to the availability and pricing of offshore dollars. Interest rate swaps reference dollar curves shaped in part by Eurodollar funding costs. Synthetic instruments allow institutions to take leveraged positions on dollar spreads without ever touching a physical note. Clearinghouses and prime brokers sit at key junctions in this network, transforming counterparty risk, but also concentrating it. A disruption in one of these nodes can propagate rapidly through the system because the same collateral and funding lines are reused, rehypothecated, and layered in ways that are hard to trace in real time. Attempts to rein in these structures run up against the basic fact that jurisdiction stops at the border, while the Eurodollar system does not. A regulator in one country can tighten rules for domestic banks, raise capital requirements, or limit certain activities. The business does not disappear, it migrates. A deal that once would have been booked in London might move to an even lighter regulation center. A hedge fund that faced new reporting obligations in one jurisdiction might reorganize under a different flag. The underlying demand for dollar funding, for dollar-denominated assets, for instruments that hedge dollar risk remains. As long as that demand exists, and as long as the dollar remains the primary global reserve currency, there will be incentives to recreate Eurodollar-style structures somewhere in the financial ecosystem. The deeper question is, what happens if trust in this parallel system is seriously shaken? A modest loss of confidence can be managed with targeted facilities and temporary guarantees. A widespread realization that many offshore dollar claims cannot all be honored at once would be another matter entirely. Because there is no single sovereign standing behind the entire Eurodollar edifice, there is no straightforward mechanism to declare a system-wide guarantee, recapitalize all weak links, or impose a coherent restructuring. Each country would look first to its own institutions and taxpayers. The Fed could provide liquidity, but not solvency. It can lend against collateral, but it cannot on its own make foreign banks or their borrowers whole. The mismatch between the global reach of Eurodollars and the national basis of political authority would become impossible to ignore. For now, the system continues under a kind of uneasy truce. Offshore banks create and destroy dollar claims every day, confident that as long as markets function and central banks remain willing to cooperate in crises, the machinery will keep running. The Federal Reserve sets policy with one eye on domestic conditions and another on the shadows cast by Eurodollar markets. Corporations, funds, and governments treat Eurodollar balances as real money for all practical purposes, even though they know, at some level, that these balances are promises layered on top of promises rather than claims on any single sovereign's printing press. The paradox at the heart of the story remains unresolved. The world's most important currency has grown beyond the institutional framework that was meant to contain it, and the institution nominally in charge of that currency can guide, influence, and rescue, but not truly control, the offshore realm where so many of its digital ghosts reside.